do central banks secretly intervene to stop deflation? Imagine a quiet battle happening behind the scenes of the economy. Central banks work tirelessly to keep prices stable, but do they ever do so secretly? The truth is, they usually don't hide their actions. When deflation threatens the economy, central banks step in with clear, deliberate measures to prevent prices from falling further. Deflation is when the overall price level drops over time, making goods and services cheaper. While that might sound good, it actually causes big problems. It can make people hold off on spending because they expect prices to fall more. Businesses see less demand, so they cut back on investment and jobs. This can lead to a downward spiral that's hard to stop. To avoid this, central banks use a variety of tools. They lower short-term interest rates, making borrowing cheaper for consumers and companies. When rates are low, people are more likely to spend and invest, helping to push prices back up. If interest rates are already near zero, central banks turn to unconventional methods like buying long-term government bonds and other financial assets. This process is called quantitative easing. It injects money directly into the economy, encouraging lending and spending. Central banks also give guidance about future policies, called forward guidance, to shape expectations about inflation. When people believe prices will rise, they are more willing to spend now. Sometimes, central banks even increase the money supply directly through open market operations or by financing government spending, which is sometimes called helicopter money. They may also implement negative interest rates, where banks pay to keep their reserves with the central bank to motivate lending and spending. These actions are generally announced publicly to maintain trust and credibility. The idea that central banks secretly intervene isn't accurate. They tend to be transparent about their policies, even if the details can be complex. They also work with government authorities to coordinate efforts, especially when interest rates are already very low. In such cases, fiscal policy measures like increased government spending or tax cuts can help boost demand. Looking at history, countries like Japan have experienced long periods of deflation when they didn't act quickly enough. Modern central banks have learned from those lessons and tend to act early and decisively to prevent deflation from taking hold. So, in most cases, central banks do intervene to stop deflation, but they do so openly and with clear strategies aimed at keeping prices stable and supporting economic growth.